What are you trading on Nadex, Jason? Are you trading binaries or are you trading spreads? Okay, so let's just say we take binaries out of the picture completely, okay? Because I highly recommend that you master spreads and before you even touch binaries. So I traded spreads for 9 months before I even traded a binary when I started trading on Nadex, like I don't know, 5 or 6 years ago. Are you trading daily contracts on the spreads, or are you trading like the intraday contracts on the spreads? So yeah, the near the market spreads. Yeah, that's good. But which expirations are you choosing? Okay, so let's do a lesson on that real quick. Okay, the closer you are, let me see if I can pull up how to have it. So, but I want to teach you why, so you understand why. What market do you trade, Jason? What's the main markets you've been trading? Oil, okay. So let's go over and it's still open, I believe. So it is open. I'm not getting anything. There we go. Reset buttons are very helpful when you are trying to figure it out. All right. So, all right. So, Jason, how wide is this spread right here? One expires at 2 o'clock. And by the way, the fastest way to do the math is to add up the risk and reward versus subtracting. So yeah, 150 ticks. Okay. Same all the way down. 150 ticks wide. All right. Now, how wide is this spread? Let's find it near the. Let's do the near the markets because that's what you're trading, right? To make it. Okay. So like, how wide is the spread right here? 500 ticks. And then let's see if they have. Okay. So one is 150 ticks. One is 500 ticks. Part of the reason that we attracted to trading the near the market spreads, the intradays, is because you put up less money. Is that accurate? That's the main reason you choose the intradays. I mean, that's why most people do. So there's less money required to do the trade. Okay. Now, if you're going to use a stop to get out of the trade, does it matter if you put up $100 of risk or $200 of risk? If you're going to get out when it goes 26 against you, per se? Does it matter how much money you're actually putting on the table? Okay, but it's not a cost. It's just money being put up. The only cost you have is your exchange fee of $1 for either one. So there is additional margin, but your risk is going to be the same either way, right? As long as you use a, you honor your stops. Okay, now if the market blows up, that one's a little nicer because, whatever. but as long as you manage your risk. Okay, here is the, I don't know if I can maybe visually put this on something. I just want white, I guess. So here. All right. So let's say you have a spread that, this is not going to be straight lines, but 150 ticks wide. Okay. Let's say this one's 500 ticks wide. Okay. If you just hit near the market, it'll automatically set max proximity to a low thing. Yeah, those are the box spreads. Okay, my fun drawing right there. I'm actually a good artist, but it's hard to draw with the mouse. Okay, so these are box spreads. Okay, and here's your near the market. Okay, yeah, it's modern box spreads, modern art. All right, so Jason, why do we buy near the market spreads? And let Jason answer this. Why do we buy near the market spreads? In order to mirror the market. Why don't we buy the ones that are like at the floor or ceiling? They move a lot slower. Okay, exactly. Because they have more premium in them, right? It's like an at the money option. Okay, so think about this. The closer this gets to the ceiling or the floor, the slower it's going to go, because the middle is like the 100% mark. Okay, but then it goes, 95, 90, 80, 85, 70, 60, 65, 50. You basically got a 50% movement like right at the money. Okay, so when you're seeing the issue already. So the narrower the spread is, the sooner it slows down as it moves in your direction. So by getting a wider daily spread, then you have one that's going to, now this one's, instead of going 100%, 95, 98, 70, 75, 65, 60, 50, you're going, 95, 90, 80, 85, 70, 75, 60, 65, 50. That applies to any market. Okay. So that's why I always say choose daily near the market spreads. So near the market, so you get that low proximity, like we're getting right now, like there's no premium in all these contracts. Okay. And then by getting the daily, it's wider, so we get that speed for a lot longer. And of course, it also speeds up as you approach expiration. But, I'd rather have the time to let the trade do its thing, because like also sometimes your spread expires and you didn't even have an exit on your trade yet, right? You choose the intradays. So knowing this, another little tip for you is thinking about the speed of it. If you buy one that's down here, maybe it has a little less risk, okay? It'll move like, say, 70, then 75, 80, 85, 90, 100. So it'll speed up. And then, 90, 95, 88, 75. So when you're looking at what spread to choose out of all these contracts, you want to get one as close as possible to the middle, ideally with, a little room on the left side. You get too much, and this is like this $83 one. Right now, since we're expiring here in, an hour, there's not a lot of premium in them, but, so it ought to move pretty much, it will move in lockstep. And that's also saying you can see, like, if you look at the pricing and it's all the same, they're all going to move the same. So I would choose You know, I wouldn't choose this $232 spread because it's going to start getting premium as it gets closer. Obviously, wouldn't choose this one, and there's not as much money to make. Okay. Um, but I mean, you could choose the $82 one because it's moving. I mean, tick for tick with the market. I mean, it's like maybe a tick off, 2 ticks off. There's a 183 and 433. So instead of putting 58 $9 up on this one, maybe you're putting up 84, maybe you're putting up 184. So that's the $1,000 wide spread right there. That's the master, what's called the master spread. So if you want the really wide one, I mean that this is ultimately how to really mirror the market. So, but if you're wanting to lower it down a little bit, then you can use the narrow one, the 500 wide ones. Okay, instead of like that's the biggest spread Nadex has actually on is that $1,000 wide oil spread. But yeah, a lot of times we're only going for 20, 30, 50 ticks anyway, maybe 100 ticks. So it's not like you need a ton of room. You just need to make sure it's moving fast and it has room to move and keep the speed. This is not going to speed up. This is already near the ceiling. This has room to speed up. This has room to speed up. This one's actually going to go a little faster. So it'd probably be a very good clip to take out, Tony. You can work with Cameron on that. Why to choose daily near the market spreads. Let's see here. There would not be an advantage to use. Oh, I like hedges over stops. So, but I wouldn't use near the market spreads. So I would use really low risk spreads that have as close a proximity as I can get. Because what I'm doing is I'm saying I'm going to give up that much profit for that protection. So basically, if you add your proximity together and your risk together, that is what you've now narrowed your risk down to. So that'd give me, like, let's say I bought the spread and I was short, that'd give me a 25 tick risk. I'd buy 10 of them to hedge an oil contract, or 5 to hedge a mini oil. But again, all those are right in here in this link. If you go in here, it tells you what the ratios are for oil. Or it should. Let's see here. Okay, the ratio is 10. I'll tell Austin to update that. Okay. Let's see here. But yeah, that's one of the main reasons people don't have success on Nadex when they're trading the spreads is because the contract slows down because they're choosing the cheaper spread. And so they're basically choosing one that's going to slow down as soon as it's like, oh, I got the proximity and the risk is low. And then why is it going so slow? I got the low proximity. Well, because you got the short one. So it's going to go into that proximity. If you look at the contract you own, it's going to rise. So like hedging on that would be 25 ticks of risk. This one would be 51 ticks. 69 ticks. So like looking at these, the best hedge would obviously be these, but it's only going to last for 21 minutes and 9 seconds. But that's 21 minute. If you want to put up I guess if your stop is, let's say, 20 ticks away, okay, you could put this on. For an extra, let's say your stop winner was 20 ticks away. For an extra 5 ticks of risk, you could let the market go 140 ticks against you, and it would make the profit to cover the hedge. It's called the ultimate hedge. So I use the low risk, usually the intraday spreads, and like this would be my choice right here. So when I get to that point where I'm like, ooh, the market may really reverse, but it also may take off when you're at like those levels, when you're in the position. That's my favorite time to go to the hedge. So because then I can get really cheap contracts. Or if you hopped in and it's moved up some in your favor, you want to hedge it off so that way now you're at basically a break even, falls back down. And time it to be right. And you can also hedge master spreads. Like you can do these $500 ones, or you can trade the the $1,000 spread on crude or whatever, and you could hedge them with the intraday spreads. So if you're like want to say I want to take 25 ticks of risk, like let's say Jason that you're trying to put together, you go in and let's say you go in and you buy this contract, and so to hedge it for the next 21 minutes, instead of taking 183 ticks and just knowing that you have a little more room, you could have for the next 20 minutes. I mean, this is sort of bad time because there's only 20 minutes left. We're near the end of the day, but for 21 ticks plus 3, so 24 ticks of risk, you could let the market move 100 and basically 50 ticks against you and only risk 23 ticks. So you could let it fly down, fly up. And what I like about the ultimate hedge is as soon as I put on a hedge to hedge my contract, trading becomes boring. And boring trading makes you a lot better trader because I've now like locked in my risk. My risk is 25 bucks on the trade. So I bought this, sold this, I've locked in my risk. And now I'm just like, please go up in the next 20 minutes. Like, I've already accepted that I can lose 20 ticks. So it's sort of a cool way. It's sort of like buying the low risk spread, but getting the benefit of the fast movement. Because the market, like I said, that thing will cover you all the way down to the floor of 47. So. Okay, well, I don't. The 5% rule at one spread, $150 cost. I don't. You're calling like There's a bad habit I think in here of calling it cost. It doesn't cost you anything. Okay, cost means you're paying for something. Okay, so that's simply the basically margin you're putting up. I mean, when you trade an oil future, you're putting up, say $1,000 or $500, whatever. Depending on your broker, most of them are $1,000. Okay, and you're controlling 100 barrels. So you're controlling a lot more money. I mean, you put up $1,000 on gold, you're controlling like $120,000 or whatever. Okay, so you're not paying for it. So that's a good way to put it. It's like margin. Okay, it's just money. You're putting up risk capital. So on Nadex, you're putting up your max risk capital. Okay, so you can't risk more than that. They've secured both sides of the trade, so nobody's ever going to go bankrupt in making sure that the trades are taken care of. Brokers are responsible to the exchange, like Ninja Trader or AMP or whoever are responsible to the exchange for all risk. So if somebody blows their account out and they can't pay it, that broker has to pay it. That's why they ask you how much money do you have, type thing, all that. Like futures brokers. So because you're controlling so much money with so little money, but you're just putting up. They're basically saying, hey, if we're going to take $1,000 out of your account, and if your account gets down to less than $1,000 value, then we're going to close your position, and we have a room of at least $1,000 before you, run out of money. So that's what a futures broker is doing. So don't look at it as cost. Look at it as what is my risk. If I'm on a chart over here, and you talked about entering, this being a valid entry right here, we had the divergence happen, and then the trend turned, green. So 3 ticks above this, and if we say, we put it. So let's say the high of this bar right here is 56.2875. Okay, so we got in, a few ticks above that. So we'll call that 56.2950. Okay, and then we'll bring up here. I'm trying to open a calculator, but it's all like freaking out on me. Anyways, 56.2950. Okay. And then we'll say we put the stop at the swing low, like 3 ticks below that. So 56.2950 minus, we'll just make it easy, 56.21. We'll say 50. Okay. 29 to 21 is what, 8? So 8 points of risk. So in that case, I mean, that'd be, what was it, $10 a spread, a point on Nasdaq? I mean, that'd be like $80 a risk. So even if you put up $150, that'd be your max risk. So of course you can tighten that up pretty quick, but so it's where your stop's going to be would be where your risk is, and so that's how you want to calculate. That's the number you're using for your 5% rule. So Nasdaq has a little higher risk value because of how it ticks, how they put it in 0.1. It used to be 0.01, which is horrible. I know it used to be like, hold on, like it was horrible. Like you basically had to move a whole point before you got a tick. I fought with them on it and showed them, and they finally figured it out. Changed it. And one of the things I tell people is never put your stop where, like, let's say your 5% rule says $30 or whatever. Okay, depending upon your account size. That doesn't mean you put your stop 30 ticks below where you got in. Okay. You have to base your stops on the market. So if the stop is too big on that market, you need to find another market where the stops are not going to be too big, where you can actually use the chart stops. So I had one guy who's like, well, 5% of my account, the 1%, whatever it is, I can do one trade. Either I win or I lose. And I'm like, yeah, not a good idea. So, like, you got to have that 5% divided by 6 rule, which means you basically have to find a instrument that has a tick value that will have stops in a place that will work for you. Otherwise, you're going to risk too much, and you're going to freak out, and that destroys traders. So now Nasdaq, there's good and bad to Nasdaq. I love trading Nasdaq, but I don't know if this will be the best time to show you. Here, let's get rid of oil. Nasdaq is, when they updated it, okay? When they updated the contract, it basically became very narrow. Okay, like $100 is 10 points wide. $300 is 300 points wide. It just became very, and 300 points sounds like a lot, but really it's 300, and then you really divide that by, let's see, every point. So if you go 300 ticks, and Nasdaq really ticks in 0.25. So since it ticks in 0.25 and it's at 0.1, it makes it really narrow. Let's look over at, I'm trying to figure out a good way to explain this. I guess it's a little hard to explain, but it's a more volatile. It's what, like, Nasdaq is more volatile than the S&P, so there's a lot more premium in it. So you're usually going to find that you have more premium in your Nasdaq contracts. You can see how, like, we're not finding very many low ones in there. As soon as they start moving, like, you can see it picks up, a little bit. Not too bad, but you definitely have to trade these. Otherwise, you're going to get like premium, like 33 ticks, 15 ticks. So be aware of that on Nasdaq, and you can always look over at the other markets, like maybe S&P or Dow or small caps. Might work. See, these are $0 contracts right here, like zero premium. So you might, if you're trading and you're not real savvy yet on how to use premium to your advantage, and you're really just trying to mirror the market, Nasdaq may not be the best market for you. But if you're doing premium trades like iron condors and iron albatross and things like that, then yes, it's fantastic. I took. Hold on one second. See if I can find it. I did not take any silver trades this morning, so I can't show you one. I've been trading Nasdaq, S&P, and the yen. Well, I just showed you like the bad orders and stuff like that. I'm either trading futures or binaries if I trade silver. I don't trade silver on Nadex because the ticks are worthless. I don't really have. I mean, I have trade like I sort of go through phases. I don't have favorite markets, but like lately I've been paying attention to the metals and then the yen, the euro with the elections coming up. It's causing volatility, and then just the indices I hop between. Like I used to have these favorites, and that got me in trouble because then like I'd rather open up 4 charts and see what's moving and trade that. So that makes sense. Like I'm just looking for what's moving. Beyond that, I really don't care what the symbol is, as long as it's moving enough. But yeah, silver is the one thing, and copper is the same. It's like 25 contracts to one, and it's because they tick really weird. Yeah, so 25 Nadex contracts take a one. Now, I mean, in one case, that's a good thing if you want to trade. Copper moves really cool, but I mean, it's worth a lot of money. So be careful if you ever trade the futures. But because it moves fast, like insanely lightning fast. But if you want to trade something like that moves sort of fast but has a low tick value, then that's how you could go like over to copper. Because when you put your stop there, you're not going to get hit real hard. Like you may lose like $5 or $10. So smaller accounts that are just getting started that want to trade live but keep their risk in check, it's going to be boring, but you're still going to learn. Copper and silver would be a good way to check that out. Yeah, let me see here. Show y'all a website I monitor when I'm trying to figure out what's going on. Let's see if I can. I mean, there's advertising and stuff on here, but I like that it streams a lot of different news, and you can make it more about what you want to make it about. So we could type in crude oil. This is financialjuice.com. And this will give you like a whole bunch of commentary. You know, gold prices drop ahead of Fed policy announcement. So on down the list. So I mean that's a place I'll go to look to see if there's something going on. One of many. But yeah, that's a beautiful chart. That's an amazing chart. There's apex short entries all the way down. You got trend catcher entries going all the way. I mean, that's just staying right within the institutional zones. And like a lot of volume. Like you can't even see, like expected is down here. Like there's a massive short sell happening. Yeah, and 100 ticks is $1,000 on oil if you're trading the future. There's tons of videos of me trading Nadex live, like mainly on the radio shows. Yeah, Jack's followed my trades. Most of the time, profitable. Every once in a while, wrong, but we've hit it most of the time, right, Jack? I call him. A lot of times I go against Tommy. He doesn't like that, but it's my money. He's going long, and I'm like, yeah, I'm going to go short right here. He's like, really? Like, yep, I'm filling your order. Thank you. Let's see here. Sorry, I'm eating an orange. What else? What do y'all got? Could be a great time. Oil could drop to 3 deviations. So if you're going to buy one, have a signal. And that's one thing like I emphasize over and over is be ready to go long or short at any given time. Like even when I'm in a trade and I'm looking at, okay, where will my exit be and all that stuff, I'm going, okay, if I'm going to go long, what needs to happen? If I'm going to go short, what needs to happen? That was that third question that I gave y'all yesterday. I said there's 4 steps. First one is I look at volume, ICE, deviations, you know, or sorry, not deviation, but volume. You know, order principle. Basically, I look at all the volume indicators and see what's going on with volume. Then I look at the levels. Then I look at if I'm going to go long, what do I do? If I'm going to go short, what do I do? Right? And then I make sure, then I go, okay, if I went short, where would I put my stop? If I went long, where would I put my stop? So on oil, now we're getting a little bit of a, we're getting a pretty cool, I mean, yesterday we called it, I said basically when it breaks this level, it will go here. And it will go here fast. And because it'll hit all the shorts and then they will take all their profit right at this point because this is where everybody else will get out and they'll be able to buy back because there'll be all the sellers, the panic sellers and everything else and the breakout sellers. And literally it hit the level, 15 seconds later, it hit the next level. And then it stopped and then bounced up. Let's see here. So with all that fun logic, you go back and go, where would the stops be? The stops are gonna they're gonna be at all these points right here where the market pulled up and shot back down. So you could literally, stops are going to be here, here. I don't have always on. There. There. These are the levels it's going to go to. So it breaks this, keeps going up. We get a long signal. Okay. Boom. Then that's where I expect it to go. So to know it's going to go short, we're going to have to really squeeze that chart because that's a big drop. We have to scroll back quite a bit. But so I was looking at where did traders have hesitation and buybacks? People took profits here, 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 and then they exited here. You can see all the volume right there. If we go over to our 10-minute chart, I'm on 5 minutes, so I'm going to change to 10. It's going to lose all the order print data. It's Lori's fault. She told me to only load 5-minute charts. And let's put this on. Oil. So the alt up and down, you can resize your bars. Okay, remember I just told you they took all their profits? Look at that. Okay. That's a telltale sign that the big boys just unloaded all their contracts. So here we go. Here's a good example. Let's go in and look at this guy. Another big bar about the same size. Looks and I looked, went a little higher, about half an hour, and then just drifted off because they were done. And it did make, pretty decent retracement. But remember, Nadex closes at 2:30. But so this could still come down a little bit more, but it is a sign that the big boys that accumulated a large sell position as they pushed it down are done. And that's why I like that 10. You can really see that spike right there on that 10-minute chart. I mean, I saw it over here just by looking at how the volume was, climbing. It's like, okay, this is an insane amount of volume. And then it drops off. So, I mean, just now we expect it to maybe oscillate around a little bit, maybe trend back up. Yeah, there's block orders all over the place on that. You did take that off. So that's why I would be careful about just buying a binary straight off of it, because again, it can do like what that bar did a second ago that we looked at. It can sort of pop up and then pull right back down. Now, if you're going in for like a shorter contract, then it'd move pretty fast. You'd be okay. But again, you have to really know how to read the ball, read the binary, and how implied volatility messes with them and everything else. Let's see here. The only way I use binaries as hedges is when I'm doing iron condors. So if I can buy them really cheap and use some of the premium I'm making to hedge off the additional risk. But I do not use binaries as hedges on directional spread trading or future trading. Daily chart for oil. So I mean, we're approaching. You can see we hit that level right there. Basically, hit it again. Okay. So it's going to have some pretty. There's going to be we're basically at a battle zone, which is where all that volume came from. And there's a little bit back here. So this gives you like on as far as a down point. Yeah, that blue line right there that you've drawn. So I mean, like if looking for it breaking down, then I'd be looking at first at this level right here, which happens to be a Fibonacci level. It's sort of funny because they'll do like fib levels and everything, and I'm like, yeah, I already have that level. Usually with the deviations, but you're just looking at things like right up. I think fibs can get a little confusing, but and then right down here. So this is probably our next big break point. If it was continuing to break down, we'd be looking at a move to 45, and that's a round number. So if it continues this dive, not today. I don't think it's moving 300 ticks. Yeah, it's not my chart, but yeah, it's fibs and Bollinger Bands. I don't use them, but some people do. I tried them for a long time, but I found out it was just really doing what I already saw without them. So it was just no ways at a certain point. Okay, legging in. If you're getting a strong trend and additional signals, then yes. Okay, so I will sometimes add in contracts when I'm really getting a strong move. So sometimes I'll be like short, 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 short. Like this pullback happens and it breaks it. Boom, okay, short again, and pullback happens, break, boom, short again. This pullback happens. Ooh, height and stop. Like so. It's one of the things traders are really bad about. Most traders will take off contracts when things are really flying in their position. If things are really going fast in your direction, I mean that's add on, right? But um, how do I put this? It's not unwise to take off contracts when you have a reason to expect there to be a battle. Okay, so that 1.5, we looked back on that daily chart. That was really good. Thanks for sharing that, Ezra. And so in the daily chart, we see that same line. So it is good to back up and look at dailies as well. Like I said, we have to go way back to find it. You pull up a daily and boom, there it was. So we're right at that same level. And so we expect a battle at this point. So this is a point where I don't care if I have another short. I'm probably not adding anymore, and I'm definitely keeping those stops tight. And I may even, since like when I hit that price level, I may take off some contracts. So battle zones you do not add, but things are flying and there's no battle zone expected. Then anytime you get any kind of pullback or extra signal that you can use, a seize, what you may have a seize chart up, you may have an order prints, whatever. That would definitely be a or apex entry. If it's flying, it's hard to get another apex entry. Like you'll get maybe one more down here because it just went so there was no oscillation to allow for an apex. So and we had them back here, which is cool. So it was apex, apex, apex. You could add in all these without getting stopped out all morning long. So those are tons of entries. Plus, I'm sure there's some bad divergences and things like that along the way. But yeah, I do like to add in. I mean, it's Tom Sosnoff says the same thing. He's like, when the market's going, like pile on. I mean, that's sometimes I end up with like 100 contracts. So, but I mean, the market has to be flying for me to do that. I have order prints on my 10-minute chart. I know some use 15 as well. So, and some use it on diagnostic charts. I just, it's however you want to set it. I like the 10-minute chart to watch volume itself, so I make sure I have it on that. It's really cool I'm really impressed how it's working on the diagnostic bars. So, but it gives me a cool view of volume because it's very clean. This is institutional, setting is 10 minutes. Let's see here. Gotta stretch it out so much just so you can see it. I just had it on 5 minutes because we were talking about our indicator that people use on 5 minutes a lot. Let's see. Yeah, I go through a lot of different ways that I look at the market, why I look at the market, and how it works, and all those live trades from the diagnostic, the show I used to do, Diagnostic Trading Hour. I think I got everyone's questions for the day. Yeah, I mean, these other indicators have been around for a long time. I know I've met some of the guys that have made them, and it's sort of funny the story behind a lot of them. I mean, they made them when computers came out. Okay, like back in the 80s, and uh, it was all the rage because before that, I mean, you basically pulled out the Wall Street Journal every day, or you manually plotted prices coming off of a ticker. Or you just purely read the tape. And so when computers came out, you could start charting stuff. Usually dailies. They weren't like doing a lot of intraday back then, but at least in stocks and stuff. And people were fascinated by these indicators, so guys came up with some formulas, put them together. They're like, "Here's my algorithm," and they sold a lot of seminars and made a whole lot of money because it was, it was new. Nobody ever seen indicators auto plotted before. So some of them were successful. Some of them, I know one guy who literally didn't use indicators that much at all, mainly price action, but people wouldn't buy his stuff if he didn't add indicators because they wanted to know how to use it. So he added some on, but he's like, I just have to do it. So I use them to bring clarity. If they're not bringing clarity to me, they're not helping me. If they're not showing me something I wouldn't know otherwise, they're not helping me. So if they're duplicating something else that I have on my screen, it's not helping me. So, but if it can show me a measurement like a trend objectively, like that short trend there we got, and then we go to this long right here, it's a good clue that the trend's really over. Don't be taking shorts anymore. I mean, you could even look for a long setup on that, right? Yeah, point and figure, and literally had the, I forget what kind of paper you call that, but it has all the squares on it. And they draw them up, plot the new price every day. Tape reading. I mean, we were sort of doing tape reading by reading order prints too. But I mean, our goal with all of these tools is to make things, even though it feels like you're looking at some massive piece of art that has 1,000 things you got to look at. As you learn what each thing means, your mind calms down. And like, okay, all I'm really looking for is volume going up, is volume going down, and where is it at in relation to expectations? You can use diagnostic bars on IZSS. The reason I like continuum bars on IZSS is because with diagnostic bars are so clean, a lot of times because they don't have that cutoff, with time, and like we don't have this kind of setting right here. I'll just show you. Okay, so we saw like we had all these apex indicators back here, like apex entries, apex, apex, apex. If we switch over, like there's such a thing as too clean, too smooth. And so I like the continuum bars because they gave me a little bit more oscillation in my bars. And they also gave me the factor of time because I trade Nadex a lot along with, futures and futures Forex. That take. Oh, it's working on it. Okay. Oh, yes, loading data. I mean, it makes for a pretty chart. It's accurate, but without the oscillations, I don't get any entries. So we got like one apex there. So today on diagnostics, it's clean. It's a beautiful thing, right? There's one apex entry. Where we had like 4 on the continuum bars. You're also not going to get near as many bad divergences because it's very clean because it doesn't factor in time. So, which makes again for a very smooth chart. So, I mean, not saying I don't like it. I mean, I made the